Hi, I'm Peter Rose, founder of Longwood Currency Trading. Accepting losses in your Forex trading is just part of the game. You just have to accept that. Sometimes those losses are larger than what you had projected that you would be accepting. We all talk about stop losses and things like that, but sometimes we go a little nutty in the head and we don't pay attention to our inner thoughts that are saying, don't take that stop loss point off, or cut that trade short because it's just not acting the way it was. So we're in April, mid-April of 2024. So I'm about 5% up for the month so far. I should be 10% up or so, only from the standpoint that I got into one of those trades and wouldn't accept the loss because I was so convinced that the trade was going to go in my favor. It should go in my favor. The economic indicators show that, and the NFPs and the CPIs and all that other kind of personal producers price index scores and unemployment scores and all that stuff. All those economic factors, the political factors in the two pair countries indicated the environment for one pair to go up and the other pair to go down, and I'm just convinced of this. So I hung on to the thing. The position ran $10,000 against me. I know. I should let it run $1,000 and get out, but I loaded up too heavy in the beginning. I had got about $1,000 up for the day. I saw that price had a lot of momentum. I put a large position on, thinking I'll just grab 3 to 5 pips. I'll make another grand, and we'll be in good shape for the day. Make up for a $500 loss a couple of days before that. It didn't go that way, and because the position was so large, the loss was so large, I froze. I couldn't pull the trigger, and it ran 10 grand against me, and I had to do the carry trade overnight and another overnight, and it just wasn't performing. It just was staying about that 10 grand, 8 to 10 grand down. And I thought, oh man, I'll just carry it over one more night because we've got there was an economic release that was coming out, and I'll see what happens there. And that brought life back. Overnight, it had gone, I think, 12,000 against me. Price just ripped on the release of that economic news. It was $5,200 against me, and I just got out. Price had come back that much. It was a spike in the price action. This can't go on, and I got out. And it's a good thing I got out because that was the absolute furthest that price went in my favor, and it would have cost me probably a couple of $1,000s more than the 5 if I would have got out then. So I got out at a good point. But the problem was I shouldn't have had to worry about that. That wasn't part of the plan, you know. And I think we really need to step back from things, which I did. I did a couple of trades the next day and did a carry, which I'm trying to get away from, but the price was moving in my direction and I was in a positive frame. I got up in the morning, the position was going really good. I loaded onto it, closed it out, and made $7,700. So I made back the $5,300 that I had lost and a couple of $1,000s up between those two trades. So I'm 5% up against my risk, not on the $2,000, but I'm a little bit more than that up for the month. But it brings me just short of 5% for the month as of the 12th of the month. So just about halfway through the month. So now, the wonderful thing of that is halfway through this month, I'm at 5% up against my risk, and it's significant risk that I'm taking. These are not small positions, and I'm not trading a a 4-figure account. I'm 6 figures. What is a reasonable percentage gain against your risk? And you have to come into that factor. It's got to be greater than real estate. Real estate, you're getting 20% on that if you're investment real estate. If you're just in your house over the 20-year period, you're getting about a 7-8% return against hard asset real estate. Same is true in stock market. You're 7-8% for that. In investment real estate, you're cash on cash on your rentals, and you could be 20% of that. So you got to beat 20% to warrant the risk that you're taking in the currency trading, because you can lose 20% in a day. In real estate, it takes a while to lose 20%. But the problem is you can get out in you can't get out in real estate, but you can get out in currencies. Regardless of that, I'm at 5% up for the month. I think I was up 12% or something last month, or I don't know. I just trade. But what the thrust of the video here is, you have to factor in the fact that you're going to do stupid shit. You will. And so all of your projections for 200% returns against your money at a 500 to 1 leverage doesn't factor in the risk of ruin, where you're going to lose it all. And even if you're trading at reasonable leverage, as I do on 10 to 1, I don't push this thing. It's part of my risk management. And a lot of people don't want to take training from me because they say, well, I can't make any money at 10 to 1. No, you can't. Not on your $1,000 account. No, you can't. You're right. Not on your $10,000 account. No, that's correct. You're starting to be able to make some money in a $10,000 account. But I'm sorry, if you don't have the money to get into this market, you're not going to make money. To get into the U.S. stock market to trade, you need $25,000, or they don't let you in the door. You could trade, I think you could trade 2 times a week or 3 times a week or something. In other words, you can make completed trades, a maximum of 2 or 3 a week, with less than $25,000. But once you start trading in the stock market, you need $25,000 just to step up to the table. If you go into the casino and you want to sit down at the Texas Hold'em table, they'll tell you you got to have 10 grand to sit down at the table. You got to have $500 to sit down at the table. So you want to sit down at the currency market, you better have $25,000 to sit down at the table, because that's where you can start making some significant money. If you had a $30,000 account, you're making $6,000 a year at a 20% return. You're matching your real estate. You're probably 55% win rate, 55-45 win to loss ratio. You're just kind of getting started. You might be able to make a couple of grand a year on a $30,000 account or something like that. Once you get more experience, what can you expect on a yearly return basis? Well, 5% a month, 50% a year. I don't know whether you're capable of doing that. Certainly 20 or 30% anyway, even as a beginner, if you learn it from me. If you're learning Bollinger Bands and fundamental analysis and all that other crap from other people, you'll spend 2 years just trying to learn that stuff, and you won't be able to make any sense of it. So I don't know what your returns are going to be. If you're trading at 500 to 1, you get lucky, you're probably making 200-300% on your money, and until you don't, and then it's gone. So I don't know what to tell you. But if you're trading 10 to 1 and you're getting say a 20% return on your money on a $30,000 account, that's $6,000. So if $30,000 is a lot of money to you, then how much money are you making a year? Maybe you're making $60,000, such that you could invest $30,000 into your trading. Jesus, you're buying $70,000 vehicles. What are you complaining about? So you got to come to the table, sell the fucking car, and put your money where your mouth is. If you had a $30,000 account and you make 30% against it, you're going to make $9,000 a year. You're making $60,000 a year in your job, and you just made $7,000, $8,000, $9,000 in your trading. Is your boss going to give you that kind of increase? That kind of return is feasible if you have the right education. And so part of the education that I provide is, let's be realistic about taking losses and factoring them in to our trading. So when I start working with somebody in a trading plan type basis, the win-to-loss ratio is really an important indicator that we have that kind of sort of dictates our trading plan. And that's the key to being able to accept losses, is having a trading plan that factors those losses into the plan. Now, depending on who you are and what your level of experience is, we're going to be factoring in adverse losses, or more losses than you could maybe conjure up on your own, maybe on 2 times a month basis. Again, we're day trading. You got 20 days a month to trade, so a couple of those days you're going to have a stupid attack until you get better at your craft. The idea when I work with somebody is to get better at your craft by understanding what those mechanics are that are reasonable to expect. You're not going to get into a trade and have it run 50 or 60 pips unless you want to carry it forward. But if you're going to want to run your profit to 50 pips, you're going to have to be up on the hourly or the 4-hour anyway. And those will have retracements of 20, 30, 40, 50 pips. So as you're zigzagging your way up, you have to be willing to take a 50 pip loss. So if you're trading a $10,000 account, that's a lot of money. It's $500. So we need to be proportional in not only what our expectations are, but what our trading plan tells us in regard to our expected wins to losses, what our average win rate is, and what are we doing with that stop loss? Where are we putting that? Where is our trading comfortability level at that for that stop loss? Experienced traders can put it out at 20 pips or 30 pips. It's not called a stop loss. It's called a panic. If something goes radically wrong, the news comes out while you're asleep that something happened and the prices just go crazy. That stop is there to get you out. A trading stop loss is different. If you don't understand the difference between those two, then some of these folks that you're seeing trading and putting these large stop losses on there, they don't ever intend to hit those stop losses because they're good enough that they don't. Well, how are you going to learn to be good enough? You have to set a short stop so that it constantly gets hit when you're learning on a $1,000 account, so that you learn what not to do. Obviously, if you're putting a trade on and you're always getting stopped out at 8 pips, you don't know what you're doing. You don't have good trade entry. So what do you have to do in order to change that? The process is one where I work together with that person to say, what are you doing? What are you trying to do? And how are we going about that that's compatible with the plan that you've created for yourself? That's really the key. So that the acceptance of risk, the acceptance of losses is part of that trading plan, and it isn't something that you say, oh shit, I've lost 4 times in a row. Oh, okay, well that's statistically you're going to do that, so don't worry about it. Well, how do you know what not to worry about and what to worry about unless you have somebody sitting beside you and saying, okay, well maybe that wasn't the thing for you to do, or did you see you made 30 pips on that trade? How did you do that? What was price action doing that allowed you to get that 30 pips? You didn't do anything. You're taking advantage of the situation. What is the situation that you took advantage of? How can we find a place to repeat that? So the acceptance of losses allows you to think with clarity, so that when you make a really stupid move and you lose $5,000 or something like that, you go, oh, that was really stupid because I did this. And as long as you can identify what you did, that's a learning experience. And maybe you won't do it again. You probably will, but the more times that you do that, the more attuned you are to, well, I'm doing something that I've done before and it didn't work out, so I'll get out early this time. That's where you want to get to. That's the acceptance of losses. Not taking the big loss after the fact and wringing your hands for 3 days over it, but looking at the price action and saying, this isn't doing what I anticipated it to do, I'm out. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.